Welcome to the May 2nd, 2022 Advance Report from McGowan Group clients and NetWorthRadio.com listeners. I'm Spencer McGowan, your financial weatherman, with a fast-paced tour of the global markets built to help our investors understand what's happening in the markets right now. And I'm also president of McGowan Group Asset Management, a team of 9 here in Dallas, with a preview of our best research that we bring each and every week to the investment committee to make great decisions for our clients. Well, Dow Jones Industrial Average, this is a one-year chart. What's significant about the one-year chart? It's at the same place it was a year ago, and the Dow is actually minus 7% so far this year. We're going to cover some of the other categories and some potential bargains coming up, in part because the Federal Reserve is creating some bargains. And we're also going to talk about what to do with the safe money. So, getting started here, notice the Dow hit almost 37,000 right at the beginning of the year, then fell to 32,300 at the Ukrainian invasion, combined with the Federal Reserve first meeting. Their second meeting of the year comes up here May 4th, and what are we going to do going forward at each Fed meeting? Well, we've got some bargains picked out actually in the fixed income area, and I want to show you the categories that are working. This category not working, the QQQ one-year total return minus 3%, that's the NASDAQ 100. Those are the biggest tech companies, and it is a tech rout. Amazon was down 12% on Friday alone. And you can see with this 20% correction in the NASDAQ, you've got a tech wreck in process, an actual bear market for the NASDAQ. If you look at the year-to-date returns, the Dow's a minus 7, S&P 500 is a minus 11, and of course we've got a minus 19 year-to-date on the NASDAQ. The indexing strategy obviously not working well so far this year, because if you went to the Vanguard Total Bond Market, it's a minus 10% on price so far this year with a yield of just 2%. Now, one solution that comes from this that I wanted to mention for the safe money markets are still at about 0.5% on their way up with the Fed raising cash rates. But the 2-year Treasury is already paying 2.5%. So if it's safe money that's going to be there for a while, that's a choice that we've been offering for the safe part of the portfolio for clients that have cash that they're going to hold on an extended basis. The other opportunity created by the Fed, global high yield fixed income, very attractive discounts, very attractive yield going forward, especially when we look at our total return objectives for portfolios. And we want to use these Fed meetings to accumulate great discounts that could be a nice capital gain by this time next year. All right, the energy sector is working. We'll move to the happy side here. We've got the energy sector over the 1-year period up 59%. That sector obviously leading the charge. The medical dividends are also doing well. Biotech is down, so the overall healthcare index is down, but the traditional medical dividends with pricing power have done as a group pretty well this year, actually in positive territory by double digits with an attractive forward yield. So you can see solutions emerging as we go forward. GDP in the first quarter, economic growth contracted for the first quarter. That took away a lot of the optimism, and that slowing growth is multiple contractions except for the sectors that have rising earnings and pricing power during inflation. What sectors are actually working? And this is really interesting because it gives us insights as to what's happening. When you hear about inflation, we've got utility bills going up, we got gasoline bills going up, and what does that do? Consumer discretionary companies had a minus 47% in earnings this quarter compared to a year ago. The overall that we saw from companies was a slight contraction in profitability. This was unexpected, and we've already got over half of the S&P 500 companies reporting. Now, on the energy sector, a 200% earnings growth, not a surprise there, 56% sales growth. The other bright spots, industrials and materials. These are companies with pricing power. So, as we go forward, you can see things like real estate investment trusts have been touted as an inflation hedge, and their earnings growth was 25% compared to last year. Some of that is the return to the office, and of course, the growth that we've seen in occupancy right here in Dallas. All right, this natural gas. I wanted to point something out on this chart. This is 25 years, all the way back to 1998. And you can see natural gas was actually, in the pandemic, at its 1998 price. This week, getting just over $8 per million BTUs, closing the week closer to 7. What's notable about that? If I go back here, I've got less than 12 months in all of history that natural gas was actually higher, and seasonally, this is quite unusual. It is a huge increase in utility bills because natural gas is the biggest source of electricity. Here on the top 10, bottom 10, I just wanted to make a couple of notes. What we do, we post at networthradio.com the charts and graphs that you see here that go with each week's extended program, and you can go to Apple Podcast, type Net Worth Radio, and you can download that. That's the more extended discussion between Alex and I that takes place each week. Be sure to subscribe here at YouTube, because we will bring you, when there's fast breaking news, we will bring you what we're doing about it in the financial markets. Here we've got the energy companies obviously leading the way. Twitter has ascended over the 90-day period to one of the top 10 with the takeover by Elon Musk. Interesting proposal this week to move Twitter headquarters from San Francisco down to just north of Austin. A Texas farm guy actually offered 100 acres. And so that was interesting. Kroger obviously has pricing power, and the rest of the companies are generally energy, with the exception of Nielsen, which got taken over. You can see Facebook, PayPal, Netflix at the bottom of the list, and part of that consumer discretionary, Stanley Black & Decker has been hit over the past 90 days. I'm Spencer McGowan, your financial weatherman, and I'm grateful that you've tuned in. Be sure to subscribe, and we'll be back next week with updates in a fast-paced market. Thank you for tuning in to Net Worth Media today, and our efforts over the past 2 decades to educate clients and help clients make great decisions. That's the reason that we're here at YouTube McGowan Group, Apple Podcasts, Net Worth Radio, and networthradio.com. The Net Worth Media effort is designed to help you make great decisions and address value at risk of loss, fluctuation in the markets. Remember, if we talk about a security, doesn't make it a recommendation until you come down and get a plan from McGowan Group Asset Management, the team that cares. You can set a Zoom meeting or an in-office meeting at the Crescent, and we'll give you a written plan that encompasses what we believe to be the best allocations. This is a team of 10 devoted to you. That includes the research that you see each week from Reuters, from Bloomberg, and from the best sources. We always post links at networthradio.com for what we believe can help you make great decisions, the research that comes up. Now, the Net Worth Media effort is also designed to address cycles in the market, value at risk of loss. At networthradio.com, you can get the ADV form that shows, yes, we're a fiduciary, a registered investment advisor. It covers the costs of hiring our team to help you in the future ahead. It really helps to have an expert team on your side that you can reach by phone, email, and of course, a team that's here for you every week to address what's going on in the markets, because anxiety can often lead investors to make decisions that are either dangerous, chasing things, or selling things when they shouldn't. And that's a big part of our planning effort at McGowan Group Asset Management. Thank you for tuning in, and we look forward to serving you and your family in the years ahead.